Hey guys, while Steven is setting up, just gonna do a quick introduction of myself. I'm Andy, I'm currently a junior, and today we're gonna be doing the second half of this lecture, focusing a lot on financial products that are on-chain, and we're also gonna have a chance at the end to talk a little bit about NFTs, which I'm sure some of you guys have heard of in the news and are pretty excited about. So, yeah. Steven, you wanna introduce yourself?
Yeah, I'm Steven. That's all. There you go.
Awesome. All right, so for today's table of contents, we first want to talk a little bit more about motivations of why some of these on-chain financial products are really important. We're going to rapidly go through some basics of futures and options in case some of you guys are not too familiar. We're going to be talking about, financial products that historically have really been specifically implemented in crypto, and we're going to be talking a lot about drilling down into the implementations of a couple of these protocols and specifically how they Lego together, like with Perpetual Protocol, Lemma, Open, and Ribbon. Steven's going to give a very brief introduction to NFTs, and I think JJ at the end is going to be talking about Stellar. All right, so in the lecture that Rutten and Anamira, I think, did about NFTs, there was an introduction about things like stablecoins, things like AMMs, and things like lending protocols. And really one thing that we really wanted to drive home that's essential to DeFi is this idea of building blocks, right? The fact that a lot of these protocols are widely available to developers on the open blockchain, and everyone can see and audit their smart contracts and really piece a lot of these different protocols together, right? So for instance, you can mint DAI from the maker contract, and you can use that DAI to deposit into Aave to borrow some other token against it, right? This is really the principal foundation ethos of DeFi, and today we're going to be going a little bit more into that. So first, want to give a rapid overview of some financial derivatives in case you guys are not too familiar. So what is a financial derivative? Essentially, instead of buying, a Tesla stock or an Apple stock today, which is called the spot market, you're betting on the future prices of certain assets, right? Hence the word derivatives, because they're not actually the underlying assets themselves. You're not actually trading Tesla stocks or Apple stocks. You're trading an asset which derives its price from another asset. So let's first give an introduction to the simplest derivative product, which is a forward contract, right? So essentially you have a buyer that commits to purchasing a given amount of asset at a price agreed today with a counterparty at a future date from another counterparty, right? So what this could look like is if you're an applesauce producer and you need a really consistent supply of apples, and the prices of apples are $1 per pound today, and you're really scared that what if in 4 months in the future there's suddenly a shortage of apples, right? Apples price goes through the roof, and you need a way to still purchase apples to make your product. So what you could do is to sign a forward contract with an apples farmer to purchase 1 million pound of apple at $1 per pound for 4 months in the future, and the two of you guys can fulfill that contract. So what is the issue with a forward contract, right? So there's actually a lot of counterparty risk given really large price fluctuation. Note that in the previous slide, we were talking about 4 months in the future, right? We have no earthly idea what's going to happen 4 months in the future. Maybe the price of an apple actually drops to like $0, right? In which case, you could risk going bankrupt, right? So if you risk going bankrupt, you can just say, I'm not going to fulfill this contract because the upsides of me just taking the bankruptcy is a lot better than potentially losing a lot of money due to this price fluctuation. The second thing is that a lot of these forward contracts are specifically designed deal by deal, which means that there is a lack of price discoverability, fungibility between different contracts, and it's a really illiquid and over-the-counter product that's specifically traded, that's specifically developed by underwriters for specific use cases. So in comes futures contract, which some of you guys might have heard of. So essentially, futures contract mitigates this counterparty risk that a forward contract inherently has by this one very simple technique, by marking to the market daily. So what this means is that in the previous chart, instead of exchanging apples for money at $1 per pound in 4 months, what actually happens is that both parties would just pay each other on a daily basis based on the fluctuations of the apple's price, right? So that way, you don't actually get a huge surprise at the end when someone can't actually fulfill the contract. And the way we further mitigate risk is to ensure that both parties has this margin threshold, right? Where using this margin threshold, you're putting in a certain amount of money designed to prevent huge market fluctuations that you can't really pay for. So futures are traded on exchanges, unlike options, and they're standardized by an expiration date and price of maturity. Hence, there's more discoverability in the price, and it's a more liquid product. So here's an example of how a futures contract works, right? So let's say we want to exchange crude oil prices, right? And we wanted to have a delivery some months. What is happening? We wanted. Does that work? Okay. Yeah, sorry about that. So we're delivering crude oil prices from the seller to the buyer, and we're promising a delivery date in December 2007. And initially, the contract is for 1,000 barrels. So both parties will put in this initial margin of $4,000 that basically protects against the next day's price fluctuation. And in futures, we call the buyer someone who has a long position, and the seller is someone who has a short position. So you can think that if the next day the price of the future changes, we would have to pay the counterparty out of the margins account just so that we avoid exchanging all this money at once at the end. So here are some use cases of a futures contract. It's essentially a volatility hedge, right? So similar to a forward contract, you can use short selling to dampen your portfolio's exposure to price fluctuations. Let's say you're an Apple's manufacturer. And the second point is that you can take on leverage positions, right? And what essentially leverage position means is that you are not speculating on just the price of a certain asset, but the price of that certain asset times some leverage multiple. And we're doing this essentially through the margin accounts. So the margin accounts, they actually swing way more aggressively percentage-wise compared to the price change of the underlying asset. So for instance, if your position has a 5% margin and the futures price goes down by 2.5%, right? Actually, 50% of your entire margin investment could be eliminated, hence giving you leverage on the underlying asset. And Steven's going to talk a little bit about options and what they are.
So when it comes to options, there's a lot of similarities between options and futures. But the main thing here is that it gives buyers the rights but not the obligation. So therefore, an option to buy or sell an underlying asset at agreed upon price, which is the strike price. So a call in this case is the option to buy a certain asset for a certain price, the strike price, and a put is the option to sell the underlier for the strike price at expiration. And these are like the things you see on Robinhood when you're trading derivatives. And an example of this is, of course, a stock option is for 100 shares of Tesla. Assume a trader buys one call option on Tesla with a strike price of $1,000. He pays $150 for that contract, the option, and then on the option's expiration date, Tesla stock shares are now selling for $1,100. So with this contract, you're walking away with $100 profit for each share times the 100 shares. So what's the main use case here? Well, first of all, you hedge against potential risk. A put option hedges against potential downward movement of a stock, while a call option hedges against potential upward movement of a stock. You're leveraging your capital. Once again, you're able to buy multiple, like 100 shares for one contract. And together, these two help stabilize the market by reducing risk exposure for both sides of the market. And then for pricing, it's basically called the Black-Scholes equation, but the main things here that matter are you take into account the current stock price, the strike price, the volatility, the option length, how long does this contract last for, and then finally the interest rates. Are there any questions on this?
Yeah, so with a forward contract, regardless of what happens to the price of the asset, you have to buy that asset for the agreed upon price. Whereas with an option, for a call option, you have the option to purchase that asset, right? Are there any further questions? These are kind of just really bare bone concepts we wanted to get across to you guys before we kind of cover their implementations in DeFi. Kind of long story short, just remember that there are counterparties in the case of a future, and the short of the future benefits when the underlying asset price goes down, and the long benefits when the underlying asset price goes up. And with an option, with a call option, you have the option to purchase a asset at some future date. And with a put option, you have the option of selling some asset at a given price in some future date. Yes? So options themselves cost money, right? So for instance, if you want to buy like Tesla stock with a strike price of $900 a few months in the future, you don't just get that optionality for free, right? You pay upfront some amount of money. And that price is calculated through the Black-Scholes equation. Yeah, any further questions before we kind of move on? All right. So the next kind of step to futures and options are what are called perpetuals. And notice something that I mentioned, that Stephen and I mentioned earlier when discussing options and futures. It's that they have a date in the future, right? Where a futures contract, you're speculating the price of an asset sometimes in the future, and in options, you're purchasing a call option or put option that gives you the ability to sell an asset for strike price at a certain date in the future. Well, what if we take that date away entirely, and you get what are called perpetual contracts? So essentially what perpetual contracts are is that they're very similar to futures contracts, but there is no settlement date, right? And this is a really radical sort of financial product that's proposed by Robert Shiller at Yale University kind of in 1996. And it's really important to DeFi because it's one of those contracts, financial contracts, that's almost used exclusively for trading crypto, right? So sort of there are centralized versions of perpetual contracts on exchanges like FTX or Binance, but as we're going to explore later, we're going to be covering the decentralized versions of these contracts. So the one thing that you really want to understand with perps or perpetual futures is that they're intended to trade very close to the underlying asset's spot price. So the spot price being the actual price in that moment of the underlying asset. So the perpetual contract of a Bitcoin at any given moment is supposed to be designed to trade similarly to the price of Bitcoin at that moment. And futures, perpetual futures are cash settled, which means that you're not actually giving someone Bitcoin when you're getting involved in perpetual futures. They're sort of settled via US dollar and in a lot of cases, stablecoins. And similar to traditional futures, you get the ability to expose yourself to leverage. So let's dive a little bit deeper in what a perpetual future actually is. So there are three main things when you're opening a perpetual future. So number one is the mark price, and this is the price that the perpetual contract is being traded at. And second, you have the spot price, which is the real-time traded value of the underlying asset. And remember what I said before, these two are supposed to be kept very similar to each other. So a user can open position with margins based on how much leverage they want to trade, which is this idea that if your margin is only 5%, then you are exposing yourself to 20% leverage, right? So perps are able to keep their mark price the same as the underlying spot price through this mechanic called funding rates, which what happens is every X period of time, the person who takes the long position on the perpetual future and the person who takes the short position will have to pay each other a funding rate based on what happens to the mark price. So the person who is longing the perpetual contract will have to pay the person who's taking the short position when the mark price is above the index price. And what this means is that the long will have to pay when the price of the underlying asset goes down, right? This is still very consistent to how futures work. And on the other hand, shorts will pay the long this funding rate when the mark price, which is the price of the perpetual future, is lower than the index price of the asset, which means that the short will pay the long when the underlying asset price goes up, right? So this is a visualization because it's kind of hard to just think about these concepts from without visualizing it. So in the beginning, so the blue line represents the mark price of an Ethereum perpetual future, and the green line represents the spot price of Ethereum. So in the beginning, they are priced the same, but let's say the price of Ethereum falls, right? So that's at time step 1. And what you have in this case is a case where the mark price of Ethereum perpetual is greater than the spot price of Ethereum. So what happens in this case is that the person who is longing the contract will have to pay the person is shorting, who is taking the short position from their margin account. So what this means is that long positions are now less desirable because when you take long positions, you have to pay a funding rate, right? So demand for taking long positions will go down, which means the mark price, which is the price of taking the long position, will go down. So this is how the mark price of the perpetual and the spot price of the perpetual are kept roughly the same. It's this idea that if you are long a contract, when the price of an asset goes down, you have to pay a fee, making the perp less desirable. And the opposite basically happens when the price of ETH goes up. The short now has to pay the long because, as you can see, the spot price is greater than the mark price. And this would cause more demand for people who want to long the contract, because every time you long the contract, when the spot price is greater than the mark price, you are earning a fee through the funding rate, right? So more demand equals price goes up. So mark price in this case will go up, and the perpetual contract will now, again, roughly have the same price as the underlying asset's spot price. Does that kind of make sense to everyone? And let me know if you have a question. Yes? You can short or long a perp. You can take a short or a long position.
So there's only, so like in a normal futures contract, there's a price, right? Like that you're trying to whatever, or like the price that you're speculating on. But in this, like it's just the same price. The strike price is the same as the spot, or the mark price is the same as the spot price.
Yeah, so basically, you're someone who is long the perpetual contract, you are speculating that before the next funding rate exchange time interval, the spot price will go up. And if you're shorting a perpetual contract, you are speculating that before the next time interval, the price will go down.
So I guess what I'm not fully understanding is, so like how do you buy the perpetual future that like what's the what do they look like? You know?
Yeah, we're gonna get into implementations of these later, but one example that you can think about would be the Binance perpetual future, which is kind of both counterparties take a position and they're being cash settled through the funding rates. So no one is actually owning any Bitcoin when you're buying a Bitcoin perp, but it's simply a way to speculate on the price of Bitcoin as well as add a leveraged position.
But like if you are like you're let's say you're speculating and you think it's gonna go down, do you buy a different product? Like do you buy a short versus a long? Like are there two different types? Or do you just buy a perpetual future?
So if you think the price is gonna go down, you just short it, right? Yeah.
From your leverage account, right?
You enter into a short position on the perpetual contract. Yeah, I think are there any more questions? If not, I'll hand it over to Steven.
Yeah, so I'm gonna go over everlasting options, but like the big thing about perpetual futures is it's mainly for leverage. Like I just think of it as a way to get leverage on your money. But for everlasting options, the main difference here is there is a strike price, right? So I guess that is, you see a better correlation with normal options here. There is once again no settlement date because it's everlasting, so there's no expiration dates. And once again, they allow for leverage. How that works though is once again, because there's no expiration date, how do you put a value on it? And how do you like keep the value in a normal territory? And that once again goes back to funding. While Andy talked about perpetual futures, they have a mark minus index for everlasting options. It's mark minus payoff. And in this case, payoff is the difference between the option price and the current crypto price. So just to give an example of an ETH call option that's everlasting, let's say it has a mark price of $2,900 and the option contract itself costs $150, and Ethereum's current price is $3,000, so there's a gap. The payoff in this case would be the $3,000 minus the strike price, which is $100, and the cost of the option is $150. So as long as you hold on to this option, you need to pay the shorts $50. So that's how they keep the price similar to the actual value of the coin itself. So what's the importance of these perpetual derivatives in crypto markets? Well, principally, it's leveraging capital, right? Because these are contracts and they don't have the actual coin behind it, you can use it to leverage your existing money. Additionally, when you have perpetual derivatives, you prevent capital inefficiencies because over a traditional option, you need to spread your capital across multiple expiration dates and multiple strike prices, but for a single perpetual, you only have one contract. And then additionally, the longing and shorting abilities of these contracts lets you protect against high volatility because this funding keeps the price of the derivatives close to the actual spot price. And finally, it removes the need to continually switch option contracts. So you don't need to switch between different expiration dates. Any questions?
So you said like you're speculating the price is going up or down in a period of time.
Yeah.
So how does it like map an expiration date? What's this period of time?
The period of time is the time between your funding. It's the time between when you need to pay the other side, basically. So sometimes it's an hour, sometimes it's 8 hours. So like,
It depends on the design of the perpetual. So, for instance, I believe most contracts on Binance are 8 hours, but as we're going to see later with Perpetual protocol, which is a DeFi protocol, it would be every 1 hour.
So just think of them as very short-term options in that case. Anything else?
And before we kind of go a little bit more into implementations, there's one point that I want to just touch on again. So the second point of preventing capital inefficiencies. So in a traditional sort of market with futures and options, there is the need of market makers to provide liquidity for a lot of these contracts with different expiration dates and different prices. So because there's less volume traded all the time in crypto and it's not a very developed market, sticking to perpetual contracts consolidates this liquidity basically. So we're going to talk a bit about implementations of perpetuals in DeFi. And there are several protocols, including Dairy, including DYDX. The one we're going to touch on today is Perpetual Protocol. And this is sort of their dashboard. We're going to talk a little bit about how to use it, what it means, and how it's implemented. So let's give an overview of Perpetual Protocol. So you are able to take long or short positions for a variety of asset pairs, such as wrapped BTC, Ethereum, synthetics, Yearn Finance. And essentially, it's 100% on-chain trading, non-custodial, right? This is kind of different than when you're buying perpetual contracts on Binance, because Binance is holding both parties' money. And this goes back, again, to the core ethos of a trustless system of a blockchain. We can't assume that Binance is a good party, right? So you can take up to 10x adjustable leverage on Perpetual. So you can take 1x leverage all the way up to 10x leverage when you're speculating the price directions of the underlying asset. And they're available on mainnet XDAI, which is a version of the sidechain that Rishi and Lawson mentioned. And they're going to be on optimistic layer 2s very soon. So as you can see on the photo on the left, this whale trader is essentially trading in USDC. And this is kind of what I mentioned earlier by the fact that these protocols, these contracts are designed to be cash settled. Because if the exchange of funding rates is the only thing that's happening between the two counterparties, there is actually no need for anyone to be owning the underlying Bitcoin or the underlying Ethereum. You simply pay the funding rate in USDC based on price directions. So let's dive a little bit deeper into how perpetual protocols are implemented. So first, I want to talk about this idea of a virtual automated market maker. So I think in one of the previous lectures, Ratan covered Uniswap, which is an example of an automated market maker. We're going to talk about how the hourly funding rate between longs and shorts are calculated, and all that good stuff. So the question we want to ask ourselves is, how do we design an AMM for perpetual contracts? And keep in mind, this is not a contract where you could have a liquidity. We basically want to think about how can we redesign virtual an AMM to be more suited for trading perpetual protocols. So this is a really rapid fire review of an AMM. You're essentially building both an exchange as well as a liquidity pool through pooling two types of tokens, bananas and oranges. And when people are trading against your liquidity pool, they're doing so using this XY equals to K function, and the assets are priced fairly on this XY equals to K curve. And the assumption of smart arbitrageurs in the system allow us to move the curve into a place that makes sense. So if bananas are actually worth a lot more than apples, then smart arbitrageurs would use this system to trade very aggressively using apples for bananas, because right now they're at a 1-to-1 ratio, and sell those bananas on an exchange that is more fairly priced, causing this price curve to shift to the left. So that's really rapid fire overview of an AMM. So what's in virtual AMM, right? So virtual AMM is actually a very beautiful concept because it uses the price discoverability of an AMM without actually storing any real underlying assets, right? So what does this actually mean? In a virtual AMM, we still have this kind of XY equals to K curve that people are trading their tokens against. So I think this is an example of a case where ETH is at $1,000 and you could trade 1,000 DAI, which is a stable coin that's pegged to the dollar for 1 ETH. So you're essentially, using this AMM for price discovery. So basically the smart contract is implemented in a way such that if you are buying, so this virtual AMM on Perpetual protocol prices the price of the mark price of the Perpetual, right? So people can trade, so people can long or short the Perpetual along this virtual automated market maker, but no liquidity is actually needed because these two counterparties are exchanging value through these stablecoin vaults, which they need to they need to use the smart contract in the beginning to lock their USDC in order to open these kind of perpetual positions. So basically, the user flow on the Perpetual protocol is when you take a long position on, let's say, a perpetual pair like Bitcoin, Ethereum, perpetual pair, you lock in collateral as USDC. That's going to be your initial and maintenance margin. And based on how the mark price and the spot price performs, the vaults of your USDC is either going to increase or decrease to reflect the funding rates. And this is how the funding rates is calculated in the actual smart contract itself. So it's deployed on chain. People can't mess with it, right? And this is kind of an example of a chronological order of an ETH USDC perpetual. So Alice is getting these long positions that are priced using the virtual automated market makers. And you can see like there's kind of slippage that's being priced in using the XY equals to K curve. And that's how we achieve price discoverability of perpetuals as a DeFi protocol. So next, I want to talk about this idea of a Lego building block, right? So if we have an underlying perpetual protocol, how can we leverage it to enable other kinds of trades in DeFi, right? So there's one idea of a kind of trade called a basis trade. So what is a basis trade, right? A basis trade is a kind of market neutral strategy, which means a basis trade does not kind of assume the direction that the underlying asset from the perpetual is moving. ETH could be moving up against Bitcoin, or it could be moving down against Bitcoin. That doesn't matter to the trader who is trading basis trades, right? So one example of a perhaps like more understandable market neutral strategy would be, let's say you take two stocks that are kind of related, right? Tesla and Ford, and you say that I'm going to make two pairs of trades, one pair of trade, where I'm going to long Tesla and short Ford at the same time. So what actually happens, right? When the market goes up, when the automobile industry goes up, you're expecting Tesla to go up more than Ford, right? So you're making the difference between how Tesla is outperforming Ford. And when the automobile industry goes down, you're assuming that Ford is going to go down more than Tesla is. So you make money from Tesla going down, and you make some money from Ford going down more than Tesla, but you also lose some money because Tesla is also going down. So basically, Lemma.finance is this interesting protocol that I found that's built on top of Perpetual protocol. that essentially allows you to take basis trade positions in the DeFi world. And this is really interesting because how Lemma protocol works is that you lock in some coin asset and it just continuously performs this basis trade on like a weekly basis, right? And you're able to kind of make some money from that trade every single time. So this is kind of an example of almost like an automated trading bot that's built using smart contracts. So that's kind of Perpetual protocol and what it enables in terms of other DeFi building blocks. And I'm gonna give it to Steven now to talk more about how on-chain DeFi options are implemented.
Okay, so for open, these are like normal options, the ones you'd see on Robinhood. They have expiration dates and strike prices. It's built on the Gamma protocol, which is their in-house developed protocol, which creates on-chain options for any ERC20 token. So basically any token on the Ethereum network can have options created. Once again, it allows for leverage via partial collateralization. And additionally, like these options and the contracts themselves can be traded as O tokens. So basically, I can send an option contract to you, and similarly, you can sell and buy these type of contracts. Additionally, there's a flash minting, which is instantaneous option contracts, and there's a lot of unique ways to leverage that. Additionally, there's this good concept called operators, which allow users to delegate their funds to third parties, and basically, you can request another company to manage your money on this network. And we'll go into that a little later. And then also there's spread collateralization in the sense that I can use one of my existing options as collateral for another option. So if I already have a $300 call, I can buy something else and use the $300 call as collateral. So Ribbon Finance is one of these operators we're talking about here. And they basically manage the money that you delegate to them through Open's on-chain operator feature. And they're using automated financial strategies to generate yield. And this strategy is like a normal strategy Wall Street would use. And in this case, they call it theta vaults. They do automated covered call selling on Open to make these profits. And right now, they're guaranteeing about 7% APY. And it ranges from like 7 to 30, depending on the coin. And basically, you're replacing the traditional position of a portfolio manager because they're doing the buying and selling for you using their bot. Any questions?
And yeah, maybe go back to the previous slide. So let me just talk a little bit more about like how Ribbon is able to achieve yield through their strategy, which is called a covered call strategy. So what a covered call strategy is basically you purchase the underlying asset, and at the same time you sell a call option. So as we covered a little bit earlier, a call option essentially allows someone else to purchase the underlying asset at a strike price in some future date, right? So in this case, you're not buying a call option using Ribbon. You're actually selling a call option to someone else based on your underlying Ethereum, right? So the flow goes something like this. So you have one Ethereum that you deposit into Ribbon. Ribbon will use Open to mint a call option token that you sell on some type of marketplace. And it basically sets this call option to a really high strike price that is very unrealistic to reach, right? So let's say Ethereum today is at 4,000, right? If we set some really, really high strike price, like 8,000, realistically, it's not gonna get to 8,000, but some people are still able to like purchase that, right? Because some people are willing to bet that I think Ethereum is gonna like go way over 8,000, right? So I wanna buy these call options in case that happens. So essentially you're basically parking your ETH on Open to continuously generate these call option tokens for a very small fee that you're selling to people for. So that's like a super brief explanation of like this strategy. I think we might be running a little low on time, but are there any questions for these sections?
Okay, so now we're gonna go over NFTs, what everyone cares about. So this is the history of NFTs. If you like kind of know this, you can talk NFT lingo. But in 2012, like the first concept of NFTs came around, and that was like colored Bitcoins. They wanted to be able to distinguish like one Bitcoin from another, and that that specific colored Bitcoin would be associated with a stock or maybe a ticket to a concert. But that was just a concept. And then from there, in 2015, that's when people would like to say the first Ethereum NFT came out. It was called Etheria. It's kind of like a board game map, and you could buy each hex in the map. And now they're going for like $100,000 or like $1 million, one or the other. And then in 2017, we see like the first main big growth of NFTs, and that's CryptoPunks. You know, as we all know. And they inspired the ERC 721 standard, which is a specific type of smart contract. And this is like the NFT smart contract. It helps people track these NFTs. It helps track like who used to own these NFTs and creates a nice chain of ownership. And now going into some of the big NFTs these days, in 2017, we saw CryptoKitties hit big major prominence. Like you can still go on like CNN and find articles from back then because they had cats selling for $100,000. And then 2018, we saw the creation of Decentraland and Axie Infinity. Decentraland being a metaverse NFT, and they're probably the most prominent metaverse NFT today, along with Axie Infinity, who is like a video game RPG type NFT. And then there was a lull in 2019 due to like the general bear market. And in 2020, we saw like the NFT market really kick off with NBA Top Shot, who were developed by Dapper Labs, the same people that developed CryptoKitties. And they reached $250 million in sales in the first half year, made big news everywhere, and kind of kicked off the current bull run. And in 2021, you just see an insane surge in popularity. Some like big things to note are we have Beeple, who's the most famous artist in the NFT space. His Everydays collection sold for $69 million in like March or something. And then Bored Ape Yacht Club is like the big, I'd say the most successful NFT in the past year. They're a profile picture NFT, and they have a market cap of about $2 billion these days. And then also CryptoPunks, the most expensive CryptoPunk sold for about $12 million a few months ago. And then just to give you an idea of what these NFTs look like, you have CryptoKitties. It's just a cat, but that's like 10 grand. You have Axie Infinity, which is like, you see those little blobs? Those are like a few grand too. But it's like an RPG game, like the video games you grew up playing. Then we have NBA Top Shot. Like the whole concept is, it's like a basketball trading card game, but instead of like just a picture, it's a GIF. So that was a real popular one. And then Bored Ape Yacht Club are these profile pictures that people put as their like Twitter profile pics or Instagram, and like this one here is like $2 million. And then Decentraland is like, metaverse is like the big thing these days because of Facebook. So Decentraland is probably the most prominent one. They're like a video game-esque thing where you see all these like, the clothes they wear, that's an NFT, and then the land itself. So if you want to build a house, you got to buy land, and that land is an NFT too. And then you have the Sandbox, which is probably the most prominent up-and-coming metaverse NFT. It's like voxel-based, and they don't actually have a product out yet, but I think they're coming out within the next few weeks. And then when it comes to like the big art NFTs, you have CryptoPunks, of course. Fidenza is probably a very prominent art NFT. Like these things go for $1 million. And then Beeple, this is his Everydays collection, the really famous one.
Yeah, and we want to kind of like make a quick point on NFTs. It's that they're not kind of just like Twitter profile JPEGs that you know are kind of for like money laundering, but they actually have a lot of like real inherent value. So as you can see, like previously in Decentraland, like you can actually own the skins, the hats, the guns, the power-up that you have in video games. And this essentially creates a new, what is called play-to-earn economy, where people are making real money by the activities that they're doing in games, right? And NFTs are a way to prove through on-chain verified information that you actually own some asset. So one instance of a more interesting NFT asset is actually in the newest sort of iteration of Uniswap. Uniswap created this slightly more complex version of liquidity provision, where you kind of have to specify a liquidity range of where on that xy equals to k curve are you providing liquidity between two tokens. So they thought it was a really good idea to also mint an NFT for someone who is providing a specific liquidity provision at a specific point on that curve with a specific amount. So this is a way to kind of like to represent your contribution to the Uniswap liquidity pool, and we're seeing a lot of protocols kind of take advantage of liquidity NFTs like this, because one tactic that a lot of people do in DeFi is this thing called liquidity mining, where in order to participate in a project early on, you help them supply liquidity on these kind of AMMs like Uniswap, right? And they will give you some reward. Well, this is a good way for you to prove that you actually provided that liquidity, kind of even if you're switching to like a new wallet that doesn't have the same on-chain history, because you can send this NFT to like another address to claim some type of token incentive that a DeFi community has.
Yeah, and going actually a bit more into like uses, like although they're not as official, like for Top Shot, like if you want to imagine an NFT as a ticket, for Top Shot, they have ways where if you have a certain amount of a collection of trading cards, they'll give you real tickets to real basketball games. So your NFT is basically an NFT of a ticket to a basketball game. And then Bored Ape Yacht Club is like notorious for hosting yacht parties in New York. And if you have a Bored Ape, you can go to this yacht party. So once again, your NFT is basically like a physical ticket. And then to quickly just go over how they work from a very like basic level, you might as well assume each NFT is its own token on the Ethereum network. And these smart contracts allow users to assign or claim ownership of digital data. So each one of these tokens has like a little bit of metadata attached to it. And this metadata is effectively a link or like a URL to the servers where the image itself is hosted. So I'm gonna host this image of this ape on like Google Cloud. I mint a smart contract which points to that image, and therefore that smart contract is now an NFT. It's like a pointer to the image. And then they are also sometimes hosted on-chain. So all your data, the image, everything is on-chain. It's not through Google, it's on-chain. And then each token has a unique identifier, like an ID, and that ID can only be linked to a single Ethereum address at once, claiming ownership. So just to give you an idea of the market map right now, in the center, you have like CryptoPunks and Hashmasks, and there's just a bunch of NFTs there. In the middle, you have the up-and-coming metaverse NFTs, Decentraland, Axie, Sandbox, etc. On the left-hand side, a few marketplaces that I want to go through are Nifty Gateway, Rarible, and probably the most famous one, OpenSea. Most of these are Ethereum-based NFT platforms where you just buy and sell. And then also, on the right side, there's infrastructure. So outside of Ethereum, there's NFTs on Flow, there's NFTs on Solana, there's NFTs on a lot of markets as long as they have smart contractability, as long as like Wax, which the MLB uses for their NFTs. So a lot of different technologies, a lot of different projects on the NFT network, and just a lot of great things. Oh, and I want to also point out ENS. ENS is like the domain name service for the Ethereum network. So normally your wallet address is a bunch of random digits and numbers. Like that's your Ethereum wallet address. What ENS is trying to do is they're trying to give your wallet address a name. So my wallet address could be Steven.eth. And you pay a little bit of money on the network, and in turn you get an NFT called Steven.eth, which is attached to my wallet address. So no longer do you have to do a bunch of like letters. You actually have a name, like a website address for your wallet. Any questions?
What NFTs did you buy, Steven?
I bought Top Shot.
Nice.
Yeah, it went up like 110,000%.
Nice.
Yeah.
All right, yeah, that's our lecture, and I think we're going to be handing it to JJ to talk a little bit more about Stellar. Yeah, thank you guys so much.
Thank you. Hey guys, to finish it off today, we're just going to talk quickly about a DeFi sort company called Stellar. What Stellar is a blockchain designed for payments and trading all types of digital money. They have a SDK and a lot of built-in support designed to help people create digital representations of any type of money. On the platform, you can create digital versions of Bitcoin, US dollars, Mexican pesos, or Argentinian pesos are a few examples of prominent projects on their platform. It uses Stellar Consensus Protocol, which allows for cheaper transaction fees and less power consumption, which make it a blockchain that's optimized for doing payments and currencies. A few distinctive features of Stellar and why it's interesting to mention is there's low fees designed to make it ideal for mirroring of all types of currencies. And there's also no financial incentive for running nodes. So the incentive is just for those that already run products on the network to promote a healthy network for themselves. So it's unlike Bitcoin or Ethereum where people are incentivized to mine or be nodes in a proof of stake type of situation. And it's also very quick and relatively speaking easy to start a project on Stellar since the ecosystem is so geared towards payments. A few notes about the Stellar ecosystem is many projects have been developed by the community. A number of them came last year and spoke to Berkeley students on a Zoom panel. A few projects in the space include stablecoins like Anchor USD and a number of other projects that make stablecoins pegged to the euro and to a few other currencies around the world. They have a developer conference every November called the Meridian Conference where there's a hackathon or some sort of opportunity to work on the platform and an opportunity to write documentation for them. And the last slide here just talks about the Stellar Development Foundation a little bit. The Stellar Development Foundation is a nonprofit that promotes the development of their network. They're a sponsor of the Berkeley Blockchain Accelerator, and they offer developer grants to those looking to develop on the platform. So if anyone's interested, just come talk to me after class or reach out. And thank you guys all for coming all semester. It's been a pleasure being here with you guys, and I'm sure Ava and Nate have a few final words for you.
Thank you, JJ. Thank you, Rishi. Thank you, Lawson. Thank you, Steven. Thank you, Andy. That was great.
Well, that's it.
I know Amrita had an announcement. I don't know where she is. Okay, so it was founded by, we were brought together by someone who was really early at Ethereum, and so we sent a bunch of students to Lisbon in October for ETH Lisbon, so I went, and then after that we started a DAO, and we currently have around $400,000, and our goal is to send more students to conferences. We're also going to be giving grants later to build startups relating to blockchain, but right now our priority is we're sending 100 students to ETH Denver, which is happening in early February for free. We're gonna give grants to fund hotels, like plane rides, everything like that. It's gonna be a really great conference. They also have a hackathon, so if you're interested, that's the application link. Please apply. We want more applications from Berkeley students. Thank you. Awesome. Thank you for sharing that opportunity. Apply. We'll post these slides so you can see the link. Attendance, Nate.
Attendance code for this week is capital B blockchain. Let's end with the classic one. I will write that out. Yeah, but other than that, thank you all for such a great semester. It's been great. Everyone who showed up for lecture has been a lot in person. It really means a lot to us. So thanks a ton, and
Thank
have
you
a great
guys.
Yeah, catch you soon. Good luck with finals, everyone. Take care.